me start off by saying that every one of you can be a millionaire. So, how do I make a million? I'm just kidding. Let's get started. Welcome to Investing 101. So, first off, I want to put this disclaimer is that read at your own and make sure that you're aware that investments does involve risk as to like, voila, my money is gone by half or my money is gone completely. So that is the risk. And the opportunities in there lies in there is that you can actually make a lot of money if you're doing the right steps and also like right understandings in terms of what is the thing that you're investing in and also what is the opportunities in there that you can actually gain and get the returns. Okay, so read at your own and let's get started. And first things I wanted to make you guys understand that investments versus trading versus gambling is actually three different world of things. So the most basic understandings things here is that investments is actually a longer journeys of putting your monies to work in the companies, for example. So for tradings will be actually much faster. Third thing is actually gambling. So, I don't think I need to actually explain too much about this, and I believe that you will know gambling a lot more than me. That you will go and buy a jackpot tickets, and hopefully the next day you will become a multi-millionaire. So yeah, that's gambling. Or maybe good things now is actually open. So be you want to get some cold air or put your money into investing in gambling casino, so that's actually your own choice. Okay, at the very bare minimum, so I need you to understand that today's sharing session is more towards investments, something that I believe is actually more towards a calculated risk, and you will know what you are doing compared to pure lucks at gambling sites, which is like hopefully the Rolex, the ball should roll towards your numbers, and voila, you get like maybe what 30 to 40x of the returns. And those are the things that is actually not be able to put much of the calculation. So that's why that's called gambling. So it's highly pure luck. But investments is not. Investment is something that you can actually do your own research. The opportunity to grow your money is highly possible in investments world. Let me get down to these topics. Basic understandings of the money. You will need to understand. I believe that every single one of us is actually using money. So why do I need to actually re-emphasize and also re-explain what is the meaning of money? So hear me out, people. Maybe my explanations of what is money and also your understandings of what is money might be a little bit different. Before I start explaining the world of investing, I would want you to understand that what is the meanings of money and what is money first. Okay, so hopefully that these understandings of money will actually make you the kickstarts of why investing is actually important. Okay, it's a medium of exchange. So generally you are using one papers, some quality papers which there is values in there to exchange for particular products. For example, like yeah, the mouse. Okay, so that is how the markets works as of now. In the past, which is season barter, where if let's say you have a chicken and I have a cow, then in exchange of the values, I would think that like maybe my one of my cow is actually worth 5 chickens. So but then you only have 2 chickens. So does it mean that like do I need to like cut my cow in order to give you 2 chickens worth of cow as a season butters? And that's is very hard to actually quantify, and also it's very difficult to make sense in terms of the exchange. Okay, so that is where money is actually come into the place as a store of values and unit of values, and also the as a medium of exchange. Okay, with monies in place, you can have a better calculated versions of values or services that you can actually trading to. So one chicken is maybe worth $20 or something. That is where money is actually coming into place, where having these forms of exchange will make things easier for the economies to work, so that every single transactions will happen more smoothly. Those will be the things that is actually so much more specific, and this form of monies, the form of a medium of exchange, would make these things possible. So that is where the existence of money. Okay, and then once we understand that money is money, then the next things to question is actually what makes money money, right? So it's a little bit confusing, but then let me explain in the forms of these US dollars so that you can actually understand a little bit more about what is money and what's wrong with money. Okay, so if you look at here, at the bottom, it's called $1 in which that in the past US dollars, $1, $1 is actually worth $1. So what this means is that if let's say you no longer want the paper notes, which is the $1, and you can actually go to the US treasuries there to exchange for $1. So at the very least, for example, let's say the whole market is actually no longer accepted currency, US dollars. At least your money is still something because you can actually go to the treasury and also exchange to a silver dollars. So that is where it has the values in there, provided that you accepted that silver has the values. Okay, in the past, US dollars is actually backed by a silver dollars, so that creates the values of this paper form that there is a value of $1. So gradually, there are some transitions. It's very hard for you to actually carry 1 kg of gold, going out and also doing the transactions and exchangings. Like, hey, I want to buy new iPhones. I give you 50 grams of gold. So that is where the money comes in place, is to more conveniency of carry here and there, and to do the transactions, to make transactions happen for the economies to work. The evolvements of the monies will go to from last time it's actually backed by silvers and then gradually it's changed to gold. This $10,000 is still backed by some things, so that will makes that your $10,000 is actually worth something because it's actually backed by the gold. Okay, and all these coins is called commodity monies. Is the silver and also the gold. So if let's say the whole market is no longer accept that these coins has the values of for example one dime or this and that, you can actually melt it down and also sell it as silver or gold. So that is the base meaning. Okay. So gradually, what happens with the monies? What is wrong with monies is that if you look at the latest newer versions of the monies, especially the current society, is that you will no longer see the sentence of this is backed by silver or backed by gold, and when previously it's actually backed by this silver, gold commodities, there is a certain values stored in the banks in the United States to making sense of these monies. But then gradually it changed. The only sentence that you can actually see on the left top here is actually the note is legal tender for all debts, public and private. I wouldn't go too deep about this sentence, but what this means is that you people, you trust that this $1 is worth $1. So thus there comes the value. Gradually you understand that what it means. Okay, but at the very least, what you need to understand here is that this is called fiat money. Fiat money that doesn't back by commodities items in the storage of the United States. Okay, when it comes down to recent this 1-2 years in terms of like there's too many people to talk about like it's no longer safe to put your monies in the banks, right? It's no longer safe to put your monies in that particular currencies. So why is that so? Reasons is because of more of these information that you can actually read online, that when pandemics happens, the US government decided to, oh no, stock market is going to crash and every single thing is going to going down, and we're going to end up with recessions and a bear market. Okay, so what that did is actually like, let's just print a lot of monies and pump it back into the stock markets and also boost the economy and also give you a stimulus package to every single one so that they have money to spend. But where does this printed money is coming from? It's out of the thin air. And to say that this explanation is that governments have the rights to continuously print monies and to put it back to the market. So that sounds something wrong, right? And if you look at this couple of articles, like the federal pumps another 75 billions, and how the government pulls 2 trillion virus stimulus monies out of thin air. And maybe we look at a few more articles here. Almost a fifth of all US dollars were created this year. This was 2020 year of article. It's actually more than 20%. But then as a general example here for you to making sense and also to understand that what is wrong with the monies is that governments have the rights to keep printing monies. So if you actually look at these understandings, let's say in the world is actually having $100, and the products that you can actually exchange, for example, one iPhones in the markets and also one mouse in the markets. So that will make things that my $100 maybe I can buy one iPhones, but then the governments continue to print monies and the markets now actually have $120. So your money is actually getting more and more common, which is actually less and less rare. That'll be worse. The more money that is actually pumping into the markets, the less values the money is in your hand. So that is start to feel like a problem, right? If you see that not only US, let's say Japan, they have the rights to continuously print money, and if you as a government, you continuously print a lot of money. For example, this year there are actually $100 in the markets, and government decided to let's just print another $100. So generally, in common sense understanding is that your money is now worth half than the previous times because the market is now already at $200, if you get a sense. So hyperinflations will happen. Inflations, which is another thing that we can talk about in the next slide. Okay. So one example here is to show that diamonds. Everybody will perceive that diamond is rare, which it is, but not at the synthetic diamonds, which you can actually generate in the lab. Okay, so that can be unlimited, but that is another topic. So another topics to talk about. But at the very least, let's use these diamonds as examples here for you to better understanding that what is wrong with money. Okay, when these diamonds is perceived as very limited, very rare, especially there's multiple ranks of different qualities of the shapes, the colors and this and that. So that will make these diamonds as very rare, and thus it comes with a value because a lot more people want these items, these diamonds, but then the market supply for these diamonds is actually very limited. So just demand and supplies, if let's say your demand is actually a lot higher than the supply, which is the diamonds that are available in the markets, it creates the values. Because, for example, if you want the diamonds at $1,000 and somebody willing to pay it at $1,200, that will gradually, continuously to make these diamonds to be more and more higher values because of the demands. Okay, so if you get a means, if let's say one day the diamond is actually everywhere, and the supply is actually so much more than the demands, what do you think that will happen? Is that the diamonds will gradually becomes more and more cheap, and you wouldn't want to willingly to pay like maybe $10,000 or $20,000 for the diamonds because you can access it at the next door or maybe next door to get it at a much cheaper price. So that is a kind of the common understandings in terms of how rare is some things to make this more valuable and more expensive. Okay. So if you correlated these diamonds with the currency, the monies, then you will having the first steps to understand that if the governments continue to print monies and print, what's wrong with it? So how much the values, the monies that I'm actually having, for example, I have 5,000, then wouldn't it be way and way less values in the markets because there's just too many cash in the markets, right? Let me share this inflation rates for the basic understandings in terms of like how economies is actually gradually transitions into the inflation things. Okay, in general explanations of this part is that if let's say this 2.5% is general explanations, not the very specific ones. If let's say today you can actually buy a bottle of waters at $1, then next year's is gonna cost $1.02.5. So 2.5% is more expensive. So that is the general explanations of how this inflation rates were explained. So which would means that if you have 5,000 and next year if you have 5,000, the 5,000 is actually worth slightly less, which is like roughly 2.5% lesser values in the markets whenever you go to the market and also shop some things. Okay, you will feel the difference. So the most easier way to understand this is actually like, for example, so your parents will always say that, oh, last time I brought maybe one nasi lemak is only 5 cents, things like that. And now you go to the markets and you buy a nasi lemak, it can cost between maybe $1 to $10 or to $20. So that is how you will actually see that the inflation is actually happening, be it whether you are aware it or not. Okay. So the values of your monies will be actually getting less and less. Even the number is actually still showing $50, right? So this is just examples on how products is actually getting more and more expensive. Like just now we talked about nasi lemak, which have you had your breakfast, right? So if you see that long ago, I forgot what versions of this iPhone is. iPhone 1, 2, 3, 3G. That was a very first few generations of the iPhone, which like the maximums of the price would actually cost $3,999. And see nowadays when the most recent iPhone 13 Pro is actually coming out, is cost $999. Yeah, the Pro Max is $1,099. So you will see that like kind of roughly 10 years ago versus the currency, a phone is cost so much more than the past already. So if let's say you have your $400 saving in the past and saying that maybe I don't want to wait few generations more before I should buy the new one because my current phone is actually still functioning, and you keep that $400, few years down the road, when for example the newer iPhone is actually coming out, your $400 might not be able to afford one iPhones anymore because of inflation and because of how technologies, every single thing is actually growing, and it just gets more and more expensive. Okay. All right. Finally, welcome to Investing 101. Right. So first off, I would like to share with you, this will be actually a bunch of investments products out there that I want to share with you guys. To at least from these very sessions, you will get to know most of the products, investments products out there. And then it's like you yourself can do your decisions on like your appetites in terms of your investments risk would be actually how high can it be, and also your greediness in deciding like which directions that you want to go for, and also what kind of returns that you're actually expecting. For example, like every single year's fixed deposits 1-2%, or maybe options tradings, cryptocurrency, and NFT and whatever it is that can maybe hopefully suddenly you should 10x your money or so. So every single things will be possible, and every single things will come to a risk as what we mentioned just now. So here we'll be actually showing you a bunch of products that I'm going to talk about today, including the risk, which is like zero risk things, and also growing to the very difficult levels, which is like maybe selling a piece of art. Okay, so level 1. Okay, level 1 is like just now what we mentioned is that like if you have $5,000 when you put under the mattress, 10 years later down the road, you will still have 5,000, but then it's like you think that your money is actually still the same, but actually it is not. So like what we mentioned just now is that your money is when you go back into the market and start shopping and start spending like how you normally would, it was decreased in terms of the values. So that is actually the problem, right? If you are actually still putting in your maybe like the famous one, put in your Milo tins and this and that, or maybe put under the mattress, so the money will not grow and it will depreciate in value. So take this in mind. This is definitely not something that you want to do. So let's go to another option, which is plan B, to plant and hopefully that the monies will grow. If let's say you actually planting apples, a tree or whatever, and it will still have returns. But then if you plant your monies in there, it will just gone case. Okay, so your 5,000 will maybe becomes no more, or maybe you can still dig it out and get your 5,000. I'm just kidding. So this is not an investment product. Okay, basically to tell you that if you're not doing anything, you will be fall behind from the society or from the economy. So every single things in life. Okay, take notes on that. Welcome to investments number one. Okay, this I believe that every single one of you, like maybe your parents or maybe even you yourselves, that would be commonly where you put more your monies at. And before you're buying the new latest iPhones or maybe new products, this and that, so that is where your money is actually storing that in hoping to gain a little bit of interest every single year. Okay, so how much it is? So maybe let's take a look at some of the examples. So bank savings. I will actually normally get some of the reference here in Southeast Asia, mainly because since I'm based in Malaysia, so those would be actually the reference that I'm actually using. Feel free to explore your country's, your own savings products, and also how much returns that they actually get. So every single country will give a different rate, and every single country's different banks will give differently. Roughly depends on maybe those banks might require more money so that they can actually go for investments, and with that maybe they will actually put a little bit higher interest to attract you guys to save it there. So take that in note. Okay, so let's take these examples here. Is that like for example CIMBs every single year, this is per annum. Okay, so if you put 100,000 in there, 0.25% is, how do I call, 250. Yeah, 250. Okay, let's say Maybank will give actually a higher rate, where if you are putting like maybe 10,000 or 50,000 here, your interest rates in returns every single year would get around 1.35% to 1.5%, which is higher than CIMB. So putting your monies on preparations before your next investments does matters, because where you put it will grow different kind of returns back to you as well. Okay, but for example, so here the investments returns that you're actually gonna expect is around like maybe like all of my examples here, well, I'm actually gonna use $5,000. So because that would be actually much easier numbers to actually have in general publics, every single one of you. If you don't have money simply because you're actually buying the latest iPhone, yeah, it's actually your own choice whether you just want to put that monies into investments, or you're just buying the latest gadget for instant gratifications, or maybe because you need a newest iPhones while your previous iPhones is not spoiled just yet. Okay, so that's your own choice. Let's take a look for maybe other savings accounts here. Some banks will offer different kind of T&Cs, and also the way they attract you to actually put your savings in there, in terms of like maybe just now we are talking about CIMB, then Maybanks. Then here, if you look at the Standard Chartered, last times the total here for the Standard Chartered privilege saver was 65%, if I'm not mistaken. Okay, then it gradually shrink down a little bit. So that was kind of like what we talked about just now, is that they might no longer find this 6% is actually too much to give to people. It's like our investments maybe just only earn 10%, and then we give out to other people, or maybe 6% or so. Or maybe they find it like even though we put like 6.5% out, it doesn't really attract a lot of people. So then might as well we use our promotions or maybe our deals to attract somewhere else, maybe like other banks products that they have. Okay, but then it's like here's the things. If you actually put your money in there, so if you see that, let's say some of the conditions that for you should have 4.3% returns every single year, is that base interest they give you 0.05%. Then if you consistently put monies every single month, reward you for that particular month's 0.75% per annum. So divided by like let's say 12 months in order to start to calculate those kind of numbers. And then spend monies, so which is another conditions like spendings on your credit cards, which is Standard Chartered credit cards, that will actually reward you a little bit more in terms of your savings, and with that they will actually give you a little bit more. So next thing is actually investments, which is like a hope that you will actually invest in their maybe mutual funds or products and this and that. So in totals, they will give you over 3% to your savings returns in your Standard Chartered account. So that would be actually some of the things that maybe you can consider, like since I'm already investing, like I might as well investing through Standard Chartered, for example, then you can actually get like over 3% on your buffer investments, on your buffer savings in the bank. Okay, then 4% versus like previous, like maybe like just now we talk about like 0.25%. It does make a difference, right? So that is just most easiest thing to actually think about, is that if I have my spare cash, where do I put my money does matter. So this is the first thing that you might actually want to actually explore. So let's say just now we talk about Standard Chartered. So in returns, like every single year, your $5,000 will grow a little bit more compared to like just now, which is a 10, 20 bucks or maybe 100 bucks. So here you can get like 200 bucks, for instance. Okay, and once you learn the most basic things like just now, because we talk about like investments does involve risk, and putting your money in your bank accounts and also growing that little things is actually, it's kind of like a guarantee thing, unless that every single year maybe change a little bit of the interest rates, but then you will not lose your money. Suppose it's still insured and also backed by the banks. So yeah. Next things we're going to talk about is actually fixed deposits, right? So fixed deposits, every single country will actually have different rates, same as just now. And so here we get some of the countries like maybe Singapore or Hong Kong, their fixed deposit rates. If you look at how fixed deposits works, is that the banks will reward you slightly higher by the tenure that you actually putting your money is there. Why? Reasons being is that the longer that you are not using those monies, the longer time frames of the calculated periods that they can actually use and also put it out there for investment products and hoping to grow more monies as a bank. Okay, so that is where they reward you. Because if you, let's say every single day people actually are taking out monies and also in and out, that would cause a buffer of monies in the banks that can be moved around. So those will be the buffer monies that they are not able to use it for maybe larger investments that comes in returns maybe 1-2 years later. So that is where they will reward you for sticking your monies there longer time frames, so that they can use it for other investment products and also get the returns and give you back a little bit as in fixed deposits returns. Okay, so that's how fixed deposit works. The longer you put, supposedly you get higher and also better rates. But the condition is that you are not able to touch your monies for that particular times of periods. If let's say during half of the periods like you just want to cancel and you actually take out monies, very likely is that not you will take so much less interest returns, or maybe you just didn't get the returns at all because of the tenures, like maybe 12 months that you're committing to. Those it will actually vary by different banks. So have a look in that. And then normally, commonly, fixed deposit will just have a time frame that you will need to actually put there and not touching it. And maybe let's say after 12 months later, then they will reward you with 0.45%. So this is worse than just now banks, but yeah, every bank's different. Okay. Investment products here is like we talk about like a DBS Singapore, Public Bank Hong Kong. So these are the information that which is up to date as of the times of my recordings here. Okay, so for the latest informations, do check out your banks and also do check out the latest on their websites, official websites, to know about the informations. Okay, so roughly there, this is what Standard Chartered. If I'm actually taking up most of their products in the investment, savings, and every single one of it, so I get 4.3%. So let's take a look at maybe a few more examples here. Is that Krong Thai? I'm not sure whether it's spelling correct or not. Yeah, I suppose. Fixed deposits, if you put it in 12 months, they will reward you by 0.4%, which is okay. Like DG Banks by DBS, this one is Indonesia's. You will see that the interest rate is actually so much better. Okay, so 3.25%, 3.5%, like a lot more higher. So this is where you will kind of understand that maybe Indonesia's markets they will actually reward you better rates, and hoping that everyone will actually save more money, for examples, or maybe the economy is that the banks need more money for investments and growing the economies, for instance. So that's where they will reward the people to save their monies in fixed deposits and give you higher returns compared to the other markets, which Singapore or maybe Thailand. Okay, so that differs by every single market. So do have a check in terms of your markets and also how every single bank would reward you with the returns of the monies that you should put there for 12 months, 24 months or so. Okay. So next thing, bonds will be contracts between you and also the companies or especially governments that requires the money to do certain projects. So that's where they actually publish out like we requires fundings of so and so amounts. And we committed to give you a payout of a higher percentage than, for example, FD. And then that will be actually like a secure, like maybe a tenure of 4 to 5 years for these bonds to matured, and you get the higher percentage of returns out of these contracts that you had agreements with the companies. Okay. Another thing to take note on this bond is that it requires a large amount of investments. Normally, it will require like let's say 100k, 250k, or 300k. Sometimes you might find it cheaper, which is like as a group buy or maybe share with other people to join to buy into the bonds maybe. Here are a few examples that I actually taken out from FSM1, okay, the website. Some of the companies will actually stated out like how much values that they committed to give you. Then I wouldn't drill down too much about this because of it's not really a starter packs friendly investments products out there, unless like you have a whole lot of monies that you want to actually like delegate like a bit of bonds, a bit of mutual funds, a bit of stock markets, then maybe it makes sense. But then the entry level here, the brackets will be actually much higher. So normally people actually go to FD or maybe straight away go to the stock markets. Okay. So here, some of the examples like a certain projects like YTLs or Power International, like things, they are actually looking for investments, a pool of so and so numbers, and in returns they are actually paying out like a few percent. For example, asking deals here, 3 to 4%. So your returns will be there, and every annually they will actually pay out the dividends until like once it's matured completely, then they will actually pay you back the full funds of amount back to you. Okay. So here will be actually the easier entry levels, which is mutual funds, or you can say the unit trust. Not too much of a difference between these two words, so doesn't really matter on this. What this means is that you are giving out your monies to the experts in terms of financial management of investment products to help you manage those pool of monies. In the commitments of like they will tell you that what is the products that they're going to invest, and also like to tell you that the past history, what's the track records, and also the research papers that they have, in order to show you and also convince you that put into my funds and I'll manage the money for you with very low fees only, which is 1-2%. So we're going to talk about that later. Okay. In the simple terms, let's have a look at this graph where there's a pool of money, okay, that you're actually paying the management fee to the fund managers, which is the team of the experts in financial investments products out there, and then they will actually provided the services which is to managing the funds, okay, so managing the pool of monies that they are collected. So then afterwards, you will need to pay a trustee fees. It's a let's treat it as an insurance, okay, insurance to protect those pool of money that if something goes off, then there will be actually a trustee that they come in and investigate and also make sure that everything's all right. So safeguard units holders' interest. Yeah. And then next thing will be actually where does those money is actually coming from, which is coming from you guys, right? So you guys are the unit holders. What this units means is that like for example, they declare like there was 1,000 units of shares in this fund, and they're actually selling to individuals, like maybe like my total investments on this fund 1,000 shares, and I have like 1 million. So one share will equal to a piece of the millions ringgits or dollars. Okay. So when you as a unit holders, you actually put your money's investments into this pool. So it's actually a joint group buy kind of things. And then what you get is actually the distributions of after the investments actually succeeded, making money, taking profits annually, for example, then you will get your share of the returns out of it. Okay. In unit trust, there will be a whole bunch of products out there, as to like there are maybe hundreds or thousands of packages that is actually available for you guys to choose from. What this means is that there will be actually fund managements that is actually more low risk, and also some is actually crazy high risk. So depends on your appetites. You will be able to understand that every single mutual funds or unit trusts are out there. They will actually tell you that the risk is actually how high, and also the potential maybe, for examples, would be actually higher than the others. But then the results might vary afterwards. Okay, so there will be something to think note about. But generally, like for example, so here will be actually taken out from the funds fsm1.com.my as well. You will see that a little bit of a difference in terms of the investment products. For example, the lowest one is actually money market funds, where they kind of actually prepare a reserve a pool of money in preparing some maybe next investments, while putting it as a storage. It might just earn interest like how you earn interest from the banks as a saving account. Okay, gradually then the fixed incomes a bit like FDs and maybe government bonds. So this would be the one that just now we talk about, which is a group buy. Okay, because individually, so I don't suppose that a lot of us might have like maybe few hundred K reserve in preparations, or I just want to buy these bonds and so on and so forth. So here would be actually an entry levels, which is much easier for you to join into the bond markets to invest on those particular products via mutual funds, which is like just now we talk about, where a group of people is actually grouping all together their monies and also buying a single product. So in returns, you will need to pay a little bit of the funds managers fees in there. Okay. Then gradually high ups money markets, which is the balance funds, money markets, fixed incomes, equity funds. Okay, so and higher, which is higher risk, like maybe stock markets. So balance funds, equity funds will be actually more towards higher and higher risk, because of when it's going to the stock markets, there will be actually thousands and thousands of companies to choose from, and every single companies will have a different categories of an industry that they're actually in, and depending on the industries that they are in, the risk and also rewards will be actually highly different. So that would be actually kind of a brief understandings in terms of the risk appetite and also the returns that you can actually look forward to. Okay, so here will be actually taken out some of the past unit trust mutual funds out there, and also to show you a little bit of information here, and also some disclaimers that they actually put up. You will know that first, investments does involve risk, and also the past is not the future. And the third one is actually at least to allow you to have a gauge to reassess whether like the fund that you actually trusted 10 years ago, whether it's actually performed well or not, so that you can actually reassess your portfolio, for example. Okay, so examples that we are looking at here, REITs is a property side of investment. So you are actually technically you are buying into maybe a shopping mall. So shopping mall is rented out to a lot of tenants, and then you will get the returns. You as like a landlord, you are just a you are a shared landlord in the pool. So that's REIT. Afterwards, we're gonna talk about that. In here, let's say it's like lower risk sometimes doesn't equal to lower returns. So if you check this out, let's talk about just maybe 5 years or 10 years, because supposedly in these topics of ours today is actually investments, and investments is actually slightly longer terms. So let's not look at fluctuations in terms of like maybe 1 month, 2 months, 3 months. And for longer and longer, economy will go to the one direction, which is growing. 5 years 30 plus, 5 years 20 plus, 5 years 70 to 80%, 5 years. Yeah, this is insane. But then at least after long term, 10 years later, then it's actually much higher. Not sure what happens these things. Then you will see that like let's say if they brought like maybe 5 years before, they brought at a higher price or something, then it crashed during that particular period. Okay, so a few years of very weak performance here, which is like 5 years ago you put $1,000, then 5 years later, if you are just like, oh, let me take out my profit, then you are gaining 4% is $40, $45. Congratulations. Okay, and some other investment products here to show you guys just examples that yeah, this would be the examples that investments does involve risk, and whatever that everybody's in the world committed to you might differ and might change eventually or maybe possibly. Okay, if you're putting like $1,000 there, 5 years later, let me take my profit. Then you're left with $500. Here will be the next things that we're going to talk about, which is how to buy one, free one. All right, welcome to stock markets, the part number 5. Okay, so this will be one of the most interesting place to be in, so to put your monies in as investments, simply because a lot of the products that you are using and also consumes every single day would be available for sale in these stock markets, where for example, like if you're everyday using Nestle products, then you can actually buy the stock. If you're using iPhone, you can buy the stock. You can, if you're drinking Coca-Cola, every single things that you consume, you will kind of understand the fundamentals of theirs, which is the consumer lines. Then from there, you can have a hint or an idea of whether the business is actually doing good or not. So that is actually like a first step to exploring the opportunities out there, and that will be very fun. So let's get started about it. Options where investors buy and sell of shares of companies, okay, small pieces of ownership. Here, what it means is that if a companies have like for example $1,000 worth of like maybe money, then they're actually releasing 1,000 shares. So each share is actually worth $1. That would be the base examples, but not very critical as of now. So let's drill down to it, and also we'll understand a lot more about the stock markets. But in general, so there will be a lot of categories of a company. So blue chips, dividend stocks, defensive stocks, growth, ETF, penny stocks, and a lot more. For example, small caps or large caps, and then the speculative stocks. And lately, there are even some new things which is called meme stocks, like meme stocks. Okay, and generally, so for you to understand is that, like for example, blue chips would be actually the largest companies in that particular country or in the world, where it's actually so stable that it's actually categorized as the top of the tops. From here, you will actually understand that these companies would hardly go south. Like for example, maybe Microsoft, or maybe in Malaysia's Maybank is very stable. So it will categorize under, like, let's say Maybank. Maybanks will be under blue chips and also a dividend stocks, and also can consider as a defensive stocks. So it's just a generalizations of understand that the companies like kind of like earn the titles that I'm actually grouping under here. One of the most interesting thing here is actually the ETF. So general understandings about ETF is that it's a group of companies under one team, and it will always stick to that formulas to continuously pick the best companies that fit into their portfolios. You don't have to do a things. It's a passive versions of mutual funds and also unit trusts. Because unit trusts and also mutual funds will be actively trading by the fund manager. So that's where you need to pay like maybe 2% to get them to actually manage your money. But here in ETF, it will be actually the passive versions of a group of companies that you are buying into. So generally, the fees would be actually way cheaper. So for example, like one of the ETF that is actually pretty popular, which is called VOO, which mimics the S&P 500 that we're going to talk about afterwards. The fees every single year is 0.03% only. So compared to 2% is a huge difference. Okay. And last will be here is penny stocks, which is something that is actually highly volatile and also highly dangerous compared to let's say maybe blue chips companies, which is very stable already. So then in hoping for penny stocks is that like if you are actually jackpots in one of them, then your growth can be maybe 10x or so. But then your money can be go down to zero as well because of the risk that is actually happening in there. Okay, so take that in mind. This would be actually the general understandings of stock market. Let's get down to a little bit more of informations in there to get to know that a lot more information that would be helpful for you for your evaluations of whether this stock market suits you. Okay. So here are examples are Maxis in Malaysia. In Malaysia, the shares will be actually categorized and count as one whole group, which is called a lot, where one lot will be actually 100 shares. So in calculations like this, is actually much more easier for you to understand is that if you look at the price of Maxis price as of this date, which is the 5th of November, the price will be 4 ringgit 70 cents MYR. Okay, and to buy one share of a Maxis, you will need to buy 100 pieces of it, so which is equal to $470. Okay, these ones will actually excluding all the fees and also charges that is actually involved, depending on which platform that you are trading on. Okay, so take that in mind. And here would be actually S&P 500, which is one of the most interesting things to talk about, is that S&P 500 group 500 largest companies in US or in the world, that is you just actually buying on the largest 500 companies in the world. And what this means is that you're actually group buying on every single piece of the companies in one particular share. Okay. So here one shares will cost around like what we talk about is $5,000. This is US dollars. Here in S&P 500, you can see that a lot of companies that you might know would be actually categorized under this. So you don't even have to select which company is actually going to be strong or maybe profitable after a few years down the road, or which are the companies that will be actually highly dangerous so that you want to avoid. So this is like a no-brainer as to I just want to buy 500 of the largest companies in the world. That's it. So Google, Amazon, eBay, Netflix, Qualcomm, Ford. What else do we know? Delta Airlines, HP, CAT, Cisco, blah, blah, blah. A lot of it that normally every single day that you might be consuming their products would be actually under here. So it's like a no-brainer to buy these stocks. And if you look at, let's say, 10, 20 years down the road from the past, which is 1987 before, I'm not sure what is the date. From here would be actually the price is maybe $200 or $300 only, and growing to here now today, 5th of November, the price is around 4,700 US dollars. So if you calculate, it's you just put there and follow the wave of the largest companies in the world. Your money is gradually keep on growing, except there are a couple of times which is a crisis. For example, Lehman Brothers, financial crisis, tech bubbles, and every single things. Depending on how you see, which causes the crash of the whole markets and also the lose of your money or the opportunities to buy more. So you yourself to decide which one is it. Okay. So welcome back to how to buy one free one. Believe that you were interested to know this, and I'm not giving out iPhones just for you to watch these sessions. I'm just sharing you that how to be more intelligent in terms of managing your finance, so that eventually you will be able to buy one free ones and hopefully free one more and give it to you, give it to me. Okay. So, of course, when we talk about Apples, definitely we are going to talk about the Apple stock, right? How you're going to get one free iPhones and also free me one iPhones. So that is the main topics of today. Okay. So, for example, recently the Apple shares price is actually $151.28. Okay. So, let's look at 1 year time frames. If you are putting your money 1 year ago in the Apple share, which was around 115, 120 is price, and growing there 1 year, just sharp 1 year's time frames, your money is actually growing by 30%. So you just follow the wave of, there's a new iPhone, there's a new MacBook Pro M1, 2, 3, and you just make more money as compared to let's say maybe FD or this. But this is not stock recommendation, so do your own research about this. Okay, and let's from here, your money of $5,000 is actually going to the 6,500, which is a lot more compared to maybe FD. But then here's the things. All of those would be very low risk or maybe near to no risk at all, because of bond or FD or maybe bank interest. Those are kind of just a guarantee things. So you wouldn't lose your $5,000. So one of the examples that we talk about, maybe let me scroll back to here. Maxis was $7 and it dropped to $4.7. So you would lose money. So not to say that this company is bad. So I'm personally using Maxis as well. So then let's look at the different time frames of when you're buying in. Okay, that will actually determines that your price and also the rewards that you're going to get in the terms of the times that you're invested in. Okay, so here will be roughly around 1.5 year. 1.5 year where around the COVID started, then it bounced back a little bit, and you decided that maybe the market crash is all gone, for example, and then your investors are also buying into these companies, for example, $1,000 or $5,000, depending on how much you are invested in. And 1.5 year down the road, you will actually growing your money by double, which is here is actually a 109%. Okay, so if you're invested in $1,000, at the end of 1.5 years later, your money's in the Apple share is actually growing by double. Okay, so that would actually translate to 10,000 already, and this would means that you are actually already get one iPhone for free through the investments. Okay, another example here would be actually like because when we talk about investments, we prefer to talk about long terms, because short terms one is actually trading. That is actually completely another skills to talk about. And here, let's say you are putting your money invested in the Apple share 5 years before, instead of buying the new iPhones. So your money is actually growing by 458%, which is not bad, right? So your money is growing to 28,000. So imagine if you are putting like maybe 10,000 or maybe 20,000, how much would it worth 5 years ahead? Okay, in futures, we might not sure what's going to happen. It might go south, it might actually continue to rise. But then in historical wise, past 5 years was great. Maybe look at a few more examples of the companies that is actually more commonly known, and we generally consume most of their products here. And also see that like if I don't know anything about stock markets, or if I don't know anything about like what companies should I pick, maybe I just pick any companies that I consume their products. Maybe this is not stock suggestions, okay? So it's just examples of how do we kind of brainstorm on where to explore, and also where to maybe study a little bit more, or maybe research before you start investing into that particular companies. Okay, so back to here, Coca-Cola. This would be all based on the 1 year. Okay, so 1 year ago was the price, and also now was the price, and also the earnings that you actually are getting. And here would be same things, which is based on the $5,000 that you're putting in. 1 year later, what is the price? What is the amount that you're gonna expect, plus the base amounts that you actually invested in. So for Coca-Cola, 8%. Then Starbucks around 22%, going pretty well. McDonald's that you eat every day, going by around 20% as well. Netflix is only 20%. I suppose Netflix should be growing a lot more higher. But anyway, so then let's look at maybe 5 years, okay? Because longer time frames might have a different story to tell. So if let's say Coca-Cola, if you're putting there for 5 years, your money is actually growing by 38% in total cumulative returns. Okay, so for Starbucks, 100 and around 16%, 170. Then McDonald's 123%, and Netflix is 462%. So compared to Apple, it's actually pretty close, which is a 450 plus percent. So here will be some of the examples of if you're buying into a good companies and also just holding on to it, you will generally, it's pretty easy to make money from the stock markets. Okay, it's about time. Okay, time is your friend. And here, let's maybe look at a few more examples, which we wouldn't drill down too much about like what these companies is actually doing. I believe that most of the companies I'm actually putting here as examples, you would know what it is about. Okay, like this is the Facebook, which is called Metaverse now, something that they're gonna shift the directions towards the virtual realities world. Google, which is Alphabet. Apple, just now we talked about. 1 year's percentage of growth, 1%, 22% for Facebook. Metaverse, Google's 69%, Apple would be at 30%. Okay, 5 years, same examples, 200+%, which is pretty good. Meta 186, Google 285%, pretty interesting, and Apple for 458%. But then this is the past performance. Okay, futures valuations might differ, so do your own research about it. So here we will give you another example. So I will give you another example, which is based in Malaysia here, where this is a blue chip dividend stock and also kind of a defensive stock as well. So here it's categorized as this, which is one of the most popular stock that Malaysians will pick as a safety net of where to they store money at. And let me show you why. So 1 year performance grow around maybe at 12%, but this is because of last time the crash of happens that around March of 2020. When it crashed, everything becomes very cheap, or everything becomes very poor, depending on which angle that you are looking at, that you are selling or you are buying. Okay, so if the market crash and you are ready to buy more, that is actually happy stories for you, because everything is actually on sale, and also everything looks so damn cheap, and you can buy a lot more. So Yeah. So Maybank 1 year you growth of 12.5%. And it's actually from 7.12 to now around most recent, which is 8.01. So 5 year performance, it's kind of 2.69% only. But then let me show you why, like just now we talked about, which is a dividend stock. Okay. Dividend stock here, 8.3%. What this means is that if you recently buy these stocks, and you can actually expect around 8% returns every single year by dividends. Okay, so you actually pay back to you. This type of stocks would be every single year they earn monies, and also they're actually paying back to the investors a lot more compared to let's say a growth stocks where they require a lot more money to invest into their products to continue to grow the whole business. Okay, so there will be actually kind of a difference between these kind of companies. So let's say if here, like, Jay, 5 years I'm only making 2%, like 2.69%, like what the dude? But let me show you one of the other things to understand here is the dividends that they're actually paying out. Okay, it's like when the stock is growing a little bit, then they take a portions to actually giving out to people, so that the stock price is actually back to around the same price as before. But then you yourself is actually already getting the dividends, which is around maybe like just now we talk about 8%. And here let's do a little bit of calculations. Okay, disclaimers here is that Maybank has a dividend policy to pay out 40 to 60% of the earnings as a dividends. So it's like Maybank is needed and also a guarantee that every single year the money that they earn, at least 40 to 60% they need to actually paying out to the investors. And the most recent few years they're actually paying out to around like 80% or so of the monies back to the investors, which is good for you. So 10 years average dividend payout 6.95. How do I calculate that? By looking at all of the past histories of how many cent of dividends that they're actually paying out every single year in order to calculate the amount that we are actually getting by the percentage. If your entry price, which is like the most recent, around 8 baht, 8 ringgit. And dividends here, because this one is actually a cent, and how many cents just divided back to the 8 ringgits, then you actually get how many percent that you're actually getting. Okay, that would be pretty simple math, right? And I already done all of the math for you, which is like here translate to this 8 ringgits, then you will be around 6.5%. Then the past, which is giving out like 2019, they're paying out 64 cents. So which translate to 8% of the dividends back to you. After all of these 10 years, then the amounts of payout for these dividends will be actually 6.95%, which is kind of isn't it so much better compared to FD? Or maybe put it as saving in the bank account. Putting money in your saving in Maybank and putting money saving in Maybank stock differ by a lot. So like previously we talked about Maybank saving account, which is around 1.35% to 1.5%. And if you save your money in Maybank share, you're getting around 7% every single year. So that differs a lot. Imagine you're actually putting 100k, 200k, and that few percent is actually a huge difference. Okay. Forex, currency tradings. So it's a pair of like, for example, US dollar change to MYR, Malaysia ringgit, then change to Sing dollar, change to Thai baht. So those changes of transactions between currencies is where you make money from, or is how every single country's economy is actually growing, is rising, or maybe falling. That differs in terms of the neighbors countries, which is using another different currencies. And from there, you will make the differences between the currency tradings. Okay. But in general, what you're gonna use every single day is actually just exchange the money so that you can go to travel, and that is Forex as well. Right. So what Forex means? For is foreign. X is definitely not your X, it's the past already. So X is exchange. Exchange to the new ones. Sorry. So in here, what's interesting about this Forex is that the Forex is way, way, way more larger compared to the stock market. So daily turnover, that's daily. Okay, daily turnover of Forex markets, 5 trillions. So in general, the most basic understandings here is that when you are changing money to go travel, for example, from Malaysia to Thailand and Thai baht, your 1 ringgit is actually able to change in 2016. Your 1 ringgit is able to change to 7.41 Thai baht, and in the most recent 2021, so your 1 ringgit is actually changing to 8.01 Thai baht, which equal to, if you are actually holding of MYR in the past, like few years back, and as of today, your MYR will be able to change a lot more, like maybe around how many percents are there? 6 to 10% of the amounts, and you get a lot more Thai baht in comparisons, and that is the difference where a forex exchange happens. Okay, so in reverse, if let's say 5 years ago you're actually holding a Thai baht and you want to travel to Malaysia, for example, so then this will be actually the differences of currency that's actually changing and also happening. So your 5,000 Thai baht, when you're changing to MYRs, the values that you're able to use to shop around will be actually much lower already. So that is differences between the forex. But generally, in forex trading, a lot of people will be actually trading forex because of how sensitive the forex market is actually happening. So, like let's say the oil price suddenly shoot up by a lot, or maybe falling by a lot, which impacting countries that is actually related to, then that is where people are actually trading for the differences and also make a lot of profits out there. Okay. Forex wouldn't recommend to beginners, but once you master the forex, that might be a huge money for you to play in that field. Starter packs definitely will recommend you guys to actually look into the stock market first, where like for example just now, which is way more easier to understand. It's like every day if I consume Coca-Cola, then I might just go and look at the Coca-Cola stock, and from there I'll actually kind of understand and also analyze that whether this company is actually doing good. But then it's like maybe 10 years or 20 years ago, I was still drinking Coca-Cola. And that means that this company is very stable, right? That would be actually much easier to look at compared to the forex, which are largely impacted by the economies itself. So economies topics would be another world of studies, like why the oil price is actually going up or going down, or why how maybe raw materials is actually changing, or the employment rates, unemployment rates is actually dropping or maybe rising, and then the economy is actually really booming. Tourism is increasing the incomes of the country, or maybe tax rates, a lot of things that is actually impacting why forex is actually fluctuating. So that would be much harder to actually kickstart and also explore. But if you are really interested, then forex might be a very good place to earn a good amount of money or lose a lot of money. So, yeah, you decide. Okay, next part will be the commodities. So this will be actually just to let you understand a little bit about like this commodities world. Not really beginner friendly at all. So yeah, the only beginner friendly things in commodities is actually the most popular tool, which is gold and silver. And other than that, not like you're gonna buy a bunch of wood and also just to resell it because you feel like, oh, I can make the margins out of it. So that is actually a completely different things to be. Okay, just now we talk about which is the stages of how difficult it is and also the potential in that. So what we're gonna do today is actually to make you explore and also to know about like what is the products, investments products out there, so that you can actually make your decisions in terms of where would you want to venture in and also explore more and also put your life savings into in hoping to grow a wealth. So actual physical products. Commodities, few categories here like chicken, cow, coffee, sugar, egg, corn, raw materials like petrol, even water, electricity, everything. Commodities, let's talk wood, a lot of like maybe steel, and then exchange trades, which is gold and silver. Let's look at some of the easiest things that if you really are into commodities, then definitely gold and also silver is the easiest thing to actually kickstart, because you can just buy 1 gram or maybe 2 grams of gold, and you are technically following the wave of whether the gold price is usually rising or falling. Okay. So let's look at maybe 1 year ago, where 1 kg of gold was worth 62,000, and 1 year later the price is 58,000. So you are kind of losing money for that particular times. Unrealized loss. Okay, if you are not selling. So 6% plus of portfolio. We want to actually look at a longer time frame, because gold, a lot of people will talk about is a store of value. Like if let's say currency no longer backed by anything, then how do we buy the most origin US dollar, which is backed by silver and gold? Is by buying the silver and gold, right? So that's but whether it's true or false, back to you yourself to decide whether gold has its value or not, or it's just because of how every single one's value gold, or just like how every single one's value diamonds as a diamonds, and it comes with values, so that's why it has a values. Personally, so I will see that gold is just gold. If you value it, it comes with values. If you're not interested in gold, that is equal to zero values. It will be slightly harder for you to quantify compared to stock markets, which is a companies where if a company sell 100 pieces of products, then you will know that how much money that the company is actually making. Okay, so that will be actually more direct way to calculate a company's potential growth versus commodities here. Okay, here let's say you're buying 2012, then that times was the highest of the times. So if you're holding on for around 10 years, only then that recently that the price is actually back to around the price of yours. Is the opportunity cost, and also depends on how you actually see the future of the gold price. Maybe when is this is it chips, then if you accumulate, then as of now it's actually great. If let's say you're buying at the tops, then yeah, so that is the risk. Okay. So if you let's say we talk about 1 year, then you kind of actually your money is actually shrinking down a little bit. So that is a goal. 12, then that times was the highest of the times. So if you're holding on for around 10 years, only then that recently that the price is actually back to around the price of yours. So it's the opportunity cost, and also depends on how you actually see the future of the gold price. Maybe when it's chips, then if you accumulate, then as of now it's actually great. If let's say you're buying at the tops, then yeah, so that is the risk. Okay. So if you let's say we talk about 1 year, then you kind of actually your money is actually shrinking down a little bit. Next part we're going to talk about is cryptocurrencies. I believe that this is the most hyped topics today, this year, and also last year and recent few years, simply because of how high the bitcoins and all of the cryptocurrencies that are actually going up crazily. So if you just simply throw stones out there, maybe you just hit a jackpot and one of the coins just boom and to the moon. Okay, cryptocurrencies compared to our physical paper form monies is that for currency that we are owning now is actually controlled by a government's country. Okay, so then in cryptocurrencies there will always be one popular term, which is decentralizations. What this means is that it's no longer controlled by one central governments, especially like institutions. So that is where people said it's no longer trusted that currency is actually getting weaker and weaker, and also holding money is just getting less and less values and worthless anymore, because of like just now the first topics that we talk about currency. The problem about money is just governments just keep printing more money, and another things about cryptocurrency is because of some of it not every cryptocurrency is actually good, and not every cryptocurrency is bad. Some of it is with limited quantity, and that is where it's that much in the world for that particular cryptos in there. So like bitcoins are 21 millions. The differences here also there is no physical counterpart, which is the paper that you are holding, or something that is actually like backed by gold or backed by silvers and every single thing. So it's just individuals separate currency in the world now. So there are just hundreds and hundreds of projects out there, and how do you evaluate that whether it is worthwhile or to invest in, and what do you believe in this cryptocurrency is seriously up to your research, because as of current it's still kind of considered early stage. Be it that bitcoins itself is actually started on 2009, which is like 10 plus years ago already. So then it getting more and more mature, and also a lot of companies is actually adopting these bitcoins, and also transactions can be made using these cryptocurrencies. So then like even Facebook's changing to a metaverse, and in there's a lot of transactions that will use cryptocurrencies, which to transact NFT, which is another thing that we can talk about, which is some art. Okay. So let's look at the master of all of the cryptocurrency, which is Bitcoin. Okay, in here we'll talk about like maybe just 1 year time frames. Then in investments we always talk about very long time frames. So just put that in mind. Okay, in 1 year time frames, because of how you can see the correlations between like the governments keep on printing monies, especially on 2020, And 2020 and 2021, this is the time frame where governments keep on printing a lot of monies and people feel insecure. So where do they go to protect their money? So one way is actually to invest in gold, silver, and another way is actually like just run to cryptocurrency, which is something that is no longer controlled by the governments. Some of the countries like maybe China will ban the cryptocurrencies. That is actually the ongoing issues because if the governments no longer be able to control, then they can't do things about it. So the only main things that they can do is actually to join this force or to ban these things. So it's kind of to delay the progress and also growth of these cryptocurrencies. Kind of. For example, when the governments keep on printing monies and you are taking fast actions in terms of let me go to put my monies into a safer bets, which is cryptocurrency doesn't control and doesn't print more monies during this period. So the changes here will be if you're invested in a 1 year time frames, then your Bitcoin is actually grow by 300+%. So as of that particular period, so your returns of 5,000 will growing like additional 15 to 16,000 here, which is very good. It's in 1 year time frame. And then if you look at the charts, the fluctuations will be actually a lot as well. This was May or March or something. The price was around 60K and near to 70K. Then it fall down to 30K. So if you can stomach this kind of fluctuations, which is 60+K to 30K is around 50+%. Like your whole portfolio, your whole money is falling by 50+%. If you can stomach that, then potentially you can get back the gains, or maybe you can get a lot more. Or there's a very good way in investing, which is dollar cost averaging. So something that we'll have an explore on, that's dollar cost averaging. And if let's say market has actually keep falling, but then you believe in that fundamentals of the company or that particular project, for example, for instance, here is actually the Bitcoin. Then if the price is actually going down, then you'll be happy because you can buy it in a cheap price. So if you are actually just speculative and also just trading, then price falling down might not be a good thing for you because you're just trading in a short period of time. So short period of time and like, oh no, maybe a few months time, then you're just losing half of the money. Then when you cannot take it anymore, then you cut loss. And that is where you lose the money. Okay, so seriously depends on how you see the fundamentals of the projects, whether eventually that project will come back up because of how people believe or because of that thing is seriously useful to the society, or maybe their services, or is just adopting by more and more companies. So that is a future potential. And if not, then let's say you're just buying some funny stocks or funny cryptos. There is another case where it's a Squid Game. Squid Game coin just disappear and your money just go from 100 to 0 instantly. So that is another thing to look at. Not everything is made equal. So take that in mind. Okay. So next things that we're going to talk about is real estate, property investments. I believe that just majority of your parents and maybe you yourself will be highly interested in actually property investment because we believe that property investments is the long-term success in growing your assets, and also like consider that on earth the land is limited, so owning the piece of land will become very valuable in the future. Consider when there's just too many demands and also too little lands out there to sell to individual. So that might be the potential things that we always talk about, which is the future potential for the investments that we are actually looking at. Okay. In property investments, let's just categorize in the few categories here, which is residential, which normally that the entry levels of ours is always buying a residential property, then rent it out. Be it you're running as an Airbnb versions of renting it daily, or you're just renting it to tenants for 12 months period of times, a longer time frames, which it will comes back to less maintenance needed because you're actually renting out to a longer time frames tenants. Okay. So next one is commercial investments. Commercial investments will involve with investments where the lands or maybe the properties that you are actually investing is rented out to offices or rented out to businesses to generating income. Okay, so it will be slightly more stable compared to residential investments because of The lower entry it is, let's say you rent it out to one person or two individual, then after 1-2 years they will actually keep on moving and maybe changing place or changing career, so that they need to move a place. Then you need to continuously do recurrings and also getting some new tenants in there. So while commercials investments, if let's say you're rented to a businesses or companies, then likely than not they will stick with the property much longer time frames until maybe their businesses actually going to a certain level that your commercials lot will not be able to fulfill their needs, then they will actually expand out. This will be actually a largest investments, which is maybe rent out as a offices, rent out even as a hotel. So this will be actually a commercials investment. Then next one is retail investments, where you're owning shop lots, then you rent it out to maybe a subway, public banks. A lot of it for them to do the front end services. So this would be on the retail investment side. So next thing is it will be a much higher level of investments, which is industrial investments, where you're go and owning a factory and rent it out to a company, a big companies out there. And those will be so much more longer time frames, maybe like your rental to one individual customer would be maybe 10 years. Okay, so much higher returns, higher stabilities and all. Okay. And next things if let's say, because all of these things involve a lot of monies that you need to invest in, especially like the higher ends, like maybe industrial investments, where maybe it take you 5 million, 10 millions, or even so much more for you to kickstart to own the factory to start rented out. So that is actually another levels of investment scheme that we are talking about. And there's one more thing, which is apology for the different graphics here. Another thing is like for you to easily entry into these property investments is called REITs. REITs, Real Estate Investment Trust. So what this means is that it's kind of like just now we talk about unit trust, mutual funds, or ETF, where you are kind of a group buyings into owning a very tiny piece of the shares that the commercial titles or maybe the businesses that is actually rented out to the tenants, and you're making a profit out of it. Owning by not owning it. Yeah. Let's use the most basic entry levels of understandings in terms of the property investments first, which is the residential investments, so that get a gauge in terms of like what is the cost and also what is the opportunity in there for you to actually make profit and also to look into, to explore more. Okay, so for residential investments, there will be a lot of costs that is actually involved in investments. So be it that maybe recent 1-2 years that there's a lot of like zero down payments, free legal fee, no S&P fees, this and that. Even free furniture, especially free aircon, all those like kitchen hood. So a lot of things. What you need to understand here is that your investments of owning a properties does involve a lot of costs, and you need to factor all of those costs into your calculations before you're making a judgment that, oh, this property, when I rent it out, then like how much that I'm gonna gain, or how much I need to actually top up every single month in order to maintain this property. So those will be the actual numbers that you will need to actually watch out for. If not, then let's say you are just buying a property and every month you are just top up monies for the monthly repayments because your tenants, let's say maybe paying you 1,008, but you're actually paying the monthly repayments for 2,005, then plus a lot of other costs that is actually involved in owning the properties. Like every single year there's a lot of sinking fees, insurance, blah blah blah. So then it's like you're kind of buying a debt. So those will be the things that you need to actually take note on when you're actually doing the property investments. If your rental can cover your payments, then that is actually a positive thing to actually kickstart and so to look at. Or the very near terms or slightly longer terms of that particular locations will be actually highly potential. So those will be something that you actually need to explore as well. Whether it is potential for you to keep holding on every single month, paying slightly debts, and in near future you can flip it at a way higher price, for example. So these are some of the just examples for you to think of, that there's a lot of cost that's actually involved. Property investments, it doesn't end with you buying the property. So there's actually a longer game of investing that's actually involved. So make sure that you check out every single details out of it first before you make any decision that property investments is for me. Yeah, buying, like maybe you're just buying a debt. So be careful on that. And the power of property investments is that there's a lot of investments tools out there that is actually using your own money to invest only. So that is actually the problem, because like for example, if I only have 5,000, then like 5,000 of 100% gain is 5,000. Okay, but then let's say if I need to actually earn so much more, then there's a lot of options out there, which is like maybe leveraging investing, which is you can use multiple times, or maybe you can actually borrow money, which is highly not advisable. Option trading. So those will be the things that you can kind of leveraging extra amounts of monies by short terms loans to make a higher gains out of your little money. Okay. One of the benefits of property investments is that your starting points of the monies that you're actually putting in is not the 500k that we actually talked about like just now, which for example, one property is actually a cost of 500k. But then you put in like maybe 5% to 10% only into the property investments, sometimes zero because of the promotion that is actually happening. But do take note in mind that the 0% for the down payments, technically they're just factored in back to your monthly installments. So just put that in mind. Okay. Benefit of property investments is that you can actually leveraging on other people's money, which is now bank loans, to making sense of that property valuations of 500k, even though that your investment amount into the properties might be maybe 50k or slightly less or slightly higher, depending on the property deal. And so that when you are renting out to other tenants, your valuations when you're actually renting out is actually based on the 500k instead of like I just putting in 50k or something. So that makes things leveraging so much higher, and your gains would be considered to be a lot more, right? Assuming that the property here 500k, the monthly repayments around 2,000 with the interest rate of 4%, 35 years loans. This one is just assumptions. So do your own calculations in terms of like what is the loan amount that you are going to loan, and that will vary, and also the interest rates of that particular times and particular country. Right. So rental incomes, like let's say ranging from 1,008 to 2,005. If it's good, then it can cover all of your monthly repayments cost, and additionally you can have buffers of monies that you can use to pay for other things. For example, like what we talked about just now, which is maybe repair fees, insurance, and a lot of it. Okay. So one very important things in property investments is regarding the interest that's actually happening. Be it that when you look at it, it's like, it's only 4%. So 4% is actually reducing balance normally. Reducing balance, what does it mean is that, like for example, you are actually loaning like 450k here, then your interest is actually counting from the 450k itself. So 4% of 450k for per annum, for example, would be very high. Here I want to show you one of the examples is that at the end of the day, for example, if your valuations of your property is actually 500k, let's say 35 years later, then your property is actually valuations is going to 1 mil. And 1 mil, you're thinking that, I'm making 500k out of this property, but is it true? No. Okay. So this is something that you really, really need to understand, is that your interest, let's take a look at this thing, is that 500k, your down payment is sorry about the link. Your down payment is 50k. Loan period is 35 years, interest of 4%. At the end of the 35 years, that once you're done paying all of the monies for these properties, that so that one day you can declare that I fully own this property, is no longer borrowed with the bank, you are paying 46% of the amount, which is actually just for interest. 46%. I repeat that. So let's look at the number. Okay. Let's say if first few years you are thinking that, my property is of 500k, then a few years down the road is grow to 550k. And you're thinking that when you sell the property, after paying all of the fees, legal fees and this and that, then you are maybe making a profit of 25k to 30k after paying all of the fees. And you're thinking that, I'm making a profit out of these investments, but is it true? So make sure that you understand about the interest, how interest works. Like just now we talk about is the amounts of interest is actually counting based on the money that you're actually loaning. Whenever you are paying the monies, you are generally not fully paying on the principal itself. So if let's say first year First year, because of your amounts of the money that you borrow from the bank is actually a lot, which is 450k, because you haven't paid on the amount of money that you actually borrows plus the principal which itself. So then every single year the interest that is actually charging on you is actually a lot. If let's say first year the 500k of property, your interest, which is you borrow money, then you need to pay the interest, and the interest is around 18k here. So make sure that you're aware of these things. How reducing balance works is that every time you will pay a lot more gradually to the principles of the amounts. Lesser and lesser, the 4% interest will be. So imagine that you continue pay until it only left 50k owing to the banks. So 50k of the 4% would be much lesser compared to here is actually based on 450k, for example. And this one is actually counting every single month by the stages of reducing balance. So always take note on that. So when it goes down to the 35 years later, the interest that you're actually paying to the bank only is not your profit, it's not your gains. It's actually a lot. So this is here is the 390k, which is just purely on the interest. Let's say here, your own investments of 50k, then plus all of the fees that is actually involving, and then plus the properties valuations after 35 years later, maybe it's become 1 million. Then after minus all of this, that is your gain. So always remember this. Okay. Definitely one thing is that there are some advantages, depends on countries where there is a property tax advantage that you can actually have as an individual or maybe as a businesses. So maybe do check out on that so that you can actually take advantage in terms of I'm paying a little bit of here, but that's actually a savings maybe 16 to 24% from the tax itself. And that is the numbers that maybe in future that we can actually explore in the discussings about that. Okay, so which is a tax topic. So after we talk about the property investment, which is a larger investments in terms of your portfolio because of the sizable amount of money that you actually need to pouring into, let's talk a little bit about the smaller ones, which is REITs. Okay, you don't need to own any single things, but then you are technically owning some things on the property investments, if you get what I mean. So in REITs, there are a bunch of investors, and they're actually doing a group buys, like just now we talk about mutual funds, stock markets, ETF, index funds, and all. Group buys for all of people that is actually joining force together to own a little piece of the property that is actually managing by some of the big companies, where they are rented out to the companies and also rent out to all of their tenants and making profits out of the rental market. Okay, and for here, when I was every single quarter or maybe annually is when they're actually gaining the profits after every single things, then they will actually distribute out all of these profits back to all the investors. Okay, then all the money will actually back to every single one of them. And there is a terms in for example Malaysian markets, the companies under this REITs portfolio management, they were required to distribute out around 70 to 90% of the profits back to all of the investors, which is you and I. Okay, and for this part will be actually a much easier entry levels, and it's kind of like a stock market where you're actually buying a piece of owning. For example, so here in Malaysia, you can own a little bit of Mid Valley, the gardens. You can own a little bit of pavilions. Then a little bit of maybe hospitals and all as well. So those are kind of the rental markets under this REITs property investments. Okay. So next things that we're going to talk about is actually a business or franchisee. Okay, so this is actually a way another levels of things that is actually under these investments, and these investments will kind of slightly different, but I want to actually put it here for you guys to at least understand a little bit about this business world and franchises, so that you can have make your own decisions that this is whether this is the path for your futures, to actively manage a business or to continue to grow it so that you can actually hire people and passively manage those business and also growing your profits out of it. Since we are talking about the long-term investments, and the long-term business would be actually one of the things that able to explore for growing your wealth and money. Okay. Running a business, you can actually start everything from scratch, where you build your own teams, build your own processes, settling all of the legal documents, and also owning a land, maybe building a storefronts and and everything. Then there is another way, which is like, for example, buying a success-proof business models, which is, for example, a franchisees, where you can actually own a store of software, you can own the McDonald's, you can own a lot of things by just subscribing to these franchisees under their big brands. So marketing, advertising, everything is actually kind of done by them. If you are actually part under the very good brands, for example, McDonald's, and everybody is actually eating that, the long-term returns is it's very stable. Okay, not to say guarantee, but it's highly stable, provided that maybe your locations, it's just not in the forest. So here are some examples which are actually taken out for Malaysia markets. This might not be the most up-to-date information, so do check out online if you are really interested into owning a business, and hopefully from that making a wealth out of it. Okay. Nelson's corn in the cup. Kintaco, Nelson's, Kintaco, 7-Elevens, which is cost around like a few hundred K. And they will require you to pay a percentage of your sales back to the mother company, which is a 7-Eleven or Berjaya. This would be actually kind of the franchises where that they will always involve a couple of fees. One is actually your starting fees, which is the investments amount that you are actually spending to decorations, renovates, and also forming some locations to start up a business. And another side is of a pool of monies that you need to pay is actually the royalty fees back to the main brands, so that they have a pool of monies. One is actually you're buying the rights to use their brands. So another part is actually contribute back to the big brands so that they can continue to advertise and also grow the business all together. So that we all coexist under this franchisee of maybe 7-Eleven. Okay. Tea Life, bubble tea, few hundred K. So here are broken down by the initial capitals, which are mainly towards setting up the locations. Then franchisee fee that you need to pay back to the mother brands, and some of the royalties amounts that you need to pay by monthly or annually, which is the percentage of your sales, which is back to the main brands. Okay. Some other brands, Ayah Penyet, few hundred K, near to a million sometimes. Whereas seems pretty cheap, but then for you to own the hotels in order to start running the business would be very costly. So do take note of that. Shins, so few hundred Ks, and then it's interesting to put McDonald's, which is a few millions. So you can see that the very established brands and also a highly recurring businesses like McDonald's, it will require a very high cost of a startup fees. And then your business is actually kind of guarantees. So give and take. Okay. So royalties of 5% together with another 5% of advertising fee. Part number 11. Okay, antiques, artworks, collectibles, and maybe the most recent one, which is NFT. So in the past, antiques, artworks will become more and more valuable as the time goes by, especially as the creator already gone. So then it suddenly becomes so much more valuable because of that. And nowadays, artists will be able to make good profits out of the art itself through NFT. So there's a lot of success stories from that. At this fund generations, artists get rewarded. So this is actually pretty good things. And that might be opportunities for you as a creators or artists to explore. This might be the place where you actually venture more of your times to grow your wealth and also grow your brand names. Okay. Here would be just giving you examples of how much a piece of art worth. So Mona Lisa, guess how much? Mona Lisa's assets at $100 million on 1962, which together with the inflations of how the money is actually expanding. So as of most recent, is actually around $850 million US for a piece of art. So arts, not sure how to tell you how to quantify arts, but it's the same thing as money and also like diamonds. If there is a willing buyers, there comes a value. Okay. And maybe Mr. Bean created another piece of art, so I'm not sure how much that worth. Just another piece of art, which this one is actually sold at 450 million at the Christie's. And then the latest generations, which is now, NFT become more and more popular, where you can copyright your piece of digital art into the ownerships that you can actually transferable to other people's by selling those arts or maybe just transfer. There's one piece of art, kind of recent, which is People the first 500 days, where it's combining the 500 piece of art into one digital artwork. And this piece of art is sold at $69 million on Christie as well. So yeah, there's a lot more. This will be the CryptoPunk, kind of an early stage of the crypto arts itself, and it grew popular. Then this one of the piece of arts which Bored Apes 8585 sold at 2.7 million at OpenSea, which is the NFT market. Imagine for yourself, like if you can sell the piece of art at a few millions, then you are done already. So some other things that is maybe worth investing is because of how you understand the market of demand and supply is easy. Shoes, Rolex, or even classics paper notes, if you can actually protect it, and maybe like years later, people are trying to sell at 50,000 for that piece of 2 ringgit note. Same case, if there are willing buyers that seriously transact that amount to you, then you make a profit. Okay. So this will be pretty much most of the things that I'm going to share with you today. And hope you learn one or two things and also like open your minds to the investing world. And hope that if you haven't started investing, do start investing. That will be actually one of the objective of this sharing. And if you are already investing, invest smart, invest wise, and invest safe. Okay. Last but not least, I want to share one or two things here as a bonus, since you guys seriously stay until now, which is maybe an hour later already listening to me, blah blah blah. I want to share with you like this logic and also this understandings of mathematics, where losing 50% and afterwards gaining 50% is not back to your 100%. Okay, let me explain a little bit of that logic and also how it impacts your investments world and also how your strategy moving forwards would be. Okay, let us use $1,000 as examples. If $1,000 you lose 1%, then you are left with 990. Put into another investment, hoping that like if I gain back 1%, I will roughly back to my $1,000. So this is kind of a recover cost before you're making profit first. And this is where things get more and more interesting. Bear in mind that I didn't put the decimals. If we put decimals, then there is a difference there. But then really not so OCD. Right? Use this the third one as an example is that if let's say your $1,000 is losing when you're actually trading some things and losing 10%, which left with $900, and then you put into another investment that you are gaining 10% back. So then your $900 growing to 10% is actually $990 only. So that is what it means. Things is getting more and more interesting when we're actually going down the hill. Okay. Like if you're 20%, then the gain that you need to actually earn back in the next investments is 25%. The reasons why I actually want to highlight this profit and loss is that sometimes evaluations of your portfolios, when to cut loss is very important, and holding on to losers might be a dangerous steps in your whole portfolio of investments. Let us go down to this information completely first, then you will get a gauge of why I say that this is very important. Okay, 30%, blah blah blah, blah blah blah, 50%, 100%. Okay, to here, it will be actually much easier for you to visualize as to like, if I have $1,000 and I lose 50% of it because I just speculatively follow some meme stocks or some random companies that I actually invested in, your $1,000 shrink to $500 and you're damn it. So I'm gonna take out the leftover monies and invest into another things, and you're so successful that you're gaining 50% from your next investments. So what happens is that your base $1,000 shrink it to $500, and your next investments is also gaining 50% because last time you're actually losing 50%. But 500 is growing 50% is actually only $750. So where is another $250? So you get the idea. Okay. So going further. Let's say your $100 you are buying some speculative stocks that fall down to you just couldn't afford to lose the investment games, and you're just holding on to a losers continuously until it fall to 90%, that you decided to, okay, I'm done, I'm just gonna play safe and invest to something better, which a better company. So your $1,000, shrink it to the 90%, the negative 90%, is to $100 only. And imagine that losing 90% of it, then left with $100. Next time, if you want to grow back to your portfolio, which is $1,000, you actually need 900%. Think about that. How hard could it be? So this is one thing that I want you to actually seriously understand about this, and also this point of ideas will help you a lot in terms of when to cut loss on the something that is actually not working, and to have a gauge in terms of your future investments. Okay. Last, I give you another bonus here, which is something that's actually very interesting. Once you understand this, it will change your idea of how to grow wealth. Okay. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Disclaimer down there. Okay. And let me explain a little bit about these points, compound interest. So take for instance, EPF dividends rates here. This is Malaysia, the retirement fund. So average dividends rates here would be around 5.92% using around the data of 10-20 years in the past. 5.92%, which kind of close to the one of the examples that we shared just now, which is Maybank's around 6 to 8%. Okay. So then let's use back the $5,000 example here. Imagine like every year you are gaining the 6% dividends, like just now we talked about the Employment Provident Fund, EPF. Plus 6%, you are gaining like to 5,300, correct? And then 5,300, when you plus, like let's say next year, you are gaining another 6% dividends. Your total money is actually not 5,600, but then suddenly there's actually additional $18. Okay, you will think that $18 is so little. I can only buy like 1 or 2 Starbucks. And then interest on interest will be one of the greatest and most interesting things in mathematics, okay, in calculations in your monies. And I will show you why. Compound interest, 10%. So these charts I'm actually basing on the calculators science.com. Compound interest, here you want to see two examples, is that the principal amount, which is $1,000, and if let's say there is actually no non-compound, which is there is no $18, like just now we talk about, where your interest can grow interest. At the end of 20 years, your money is actually go to 3,000. But with compound interest, your money is actually growing to more than 7,000. And I show you a little bit more about this. So your investments, $5,000. Dividends, 6%. 6% is very achievable, like just something I already showed you, which is EPF, then Maybank. So then stop questioning whether like, oh Jay, this is not possible. It's very hard to find the investment that give me guarantee or maybe give me 6% every year. I just showed you. Okay. So non-compound interest and compared to the compound interest on the right side. Let's look at it. Here, you will look at the first year until the 15 years. 15 years later, the differences here will be around like 1-2,000 when your interest can grow interest on the right side. So, but then let's look at the slightly longer terms, which is 50 years later. If let's say your interest is actually not growing interest, at the end of the day, you're just based on the $5,000 to gain 6%, which for example, every year you are gaining 6%, but you're not reinvesting that amount back to your portfolios. You're just going out and also just spend. So that is kind of what happens. And at the end of the day, 50 years later, your portfolio is only grow to 20,000. But if you continue to reinvest, for example, reinvest back to the Maybank, reinvest back to the investments that you have, 50 years later, the differences can be 4 to 5x, which is 92,000. Okay, so But then maybe for you is that how many 50 years do we have? And I will show you a little bit further to making sense that why this is worth your time. So let's say that 10%. 10%, then maybe afterwards you're yourself telling me that, Jay, I can't even find any investments that can guarantee me 3% or 4%. I just showed you, which is like 7 to 8%. If you buy during the crash or not, 10% sometimes might be hardest, but later on I will show you there is a way as well, which is pretty easy as well. So do your own research. Okay, we're back to here is that let's just use the 10% as an example. Okay, if let's say compound every single year at 10% because you don't have so many 50 years, right? So let's just use a larger, slightly larger number to show you what is possible. Okay, this will be the number. Think for yourself for a second that if let's say you every single year you just keep on splurging on buying unnecessary things, and also like every year your dividends you just taken out and also go and spend versus your reinvesting back to the portfolios, 10% 50 years later your non-compounding interest is only 30,000. But then if you reinvest all of the amounts, 50 years later you kind of get like 600k. So go and do your own maths. Go and online find the compound interest calculators and also find it for yourself that whether this is true. Okay. I give you an examples of how it is so achievable to become a millionaire, since I kind of told you that you can be a millionaire, and suddenly you're gonna scold me in the comments down below saying that you didn't show me how. So here I show you. Okay. So let's say initial investments of yours is only 600 bucks. Whatever currencies of yours, doesn't matter, 600. Then every single month you just save additional 600. Okay, because like just now our compound interest is that you put amount of money which is $5,000 and you're not adding any single amount of money already. And at the end of the 50 years, if let's say based on the 10%, you're actually already like 600k. Okay, but then every single month of hours in actual life, definitely you are earning more incomes, right? So then it make more sense that you continue to compound that amount and also getting a better life of yours in terms of the wealth and also money management. So here, let's just use 600 bucks to put in every single month as a savings and see how insane that particular numbers can be, or maybe how boring the final numbers can be. So length of the times 35 years. Since we are talking about like property investments, also like 35 years times anyway. And the estimate interest rates, I'm going to use 7%. 7%, very achievable. Don't tell me that this is not possible. If not, then I will use the comment and come and smack you behind the scene. Okay. So compound interest annually, every single year you're growing your amounts, which is 7% based on all of your money that you're putting in. And here will be the result. At the end of 35 years, you are a millionaire, whatever currency. So all your need is actually 600 bucks savings every single month, putting into Maybank or whatever safe investments it is, they're growing you 6 to 7%. You are already a millionaire. How easy it is. It's that simple. Okay. The amount that you're putting in 600 every month, 600 saving 600. Kind of don't tell me that like 10 years later your earnings is still the same. That smack you another side as well to make you awake and also questions what's wrong with you. Okay, definitely you're gonna invest a lot more, and hopefully that you don't splurge on some random things and buying more expensive car, buying more expensive luxury goods just simply because you can. Okay, along the journey, if let's say here every single month only putting 600, and at the end you already have $1 million. It's just that simple. So everyone can be a millionaire. So is it true? You decide. Just now we talk about is that 7% is achievable, but maybe 10% might not be, because like 10% is very hard to find, Jay. So I'm showing you one of the example here is like Remember we talked about S&P 500 before just now. Here is one of the articles, and also this is the historical data. It doesn't mean the future would be exactly the same, but as indicators, we have 100 years of data to prove and also to show that what is possible. Okay, S&P 500 originally begins in 1926. It's not really 100 years, but close to. So that times it was a S&P, like kind of S&P 90. So there's a 90 stocks only. So generally this S&P 90 or 500 will consist of 90 or the 500s of the largest companies in the world, basically USSI. And if you just only put into S&P 500, one of the Warren Buffett supporters of this S&P 500, your gains for every single year is approximately 10 to 11%. So you tell me, it's that simple. You just the logic here is actually very simple, is that you just buying into the smartest and also largest and also most successful companies in the world and follow their wave of growing in the economy. That's it. So average returns after it expand out to be the smartest 90, then the compared to the smartest 500, which is a larger sampling data, the returns will be slightly fall a little bit, which is like 1957 through 2018. The returns every single year is 8%. So drop a little because you are not investing into the smartest 100 companies. So that is where personally I prefer Nasdaq 100, which is this 100. And Nasdaq 100, there's another which is called QQQ. That is my favorite. So I'll just actually throw that index and you can grow with money. Okay. Average returns annually from 1926 until 2018. So this is based on the 90 stocks, and plus gradually it's actually changed to 500. So if you are using these long-term time frames, the returns around 10 to 11%. Consists of the crash, consists of the growth, but depends on when you buy. For example, you are buying at the tops, then your returns might differ. Dollar cost averaging will be actually another important thing that you need to actually study, and simply means that like every single month you're just adding 600, so that is kind of a dollar cost averaging. Okay, when it is actually 500 stocks, S&P 500, the returns every single year is around 8%. With that, thank you very much. And last but not least, make sure you like, subscribe, and comment down below to help the platform algorithms to grow, and hoping that these videos will reach more people and also help more people. I'm just saying, to be or not to be is your own choice. Thank you.